Hello everybody, my name is Shivani Jain and I'm a partner here at Sax. Welcome to Q4 Tax with Sax, our year-end webinar where we talk about all the planning ideas in the different areas of taxation. Before we get started, I would just like to read that our firm provides the information in this webinar presentation for general guidance only, and that does not constitute the provision of legal advice, tax advice, accounting advice, investment advice, or professional consulting of any kind. The information provided herein should not be used as a substitute for consultation with professional tax, accounting, legal, or any other competent advisors. Before making any decision or taking any action, you should consult a professional advisor who has been provided with all the pertinent facts relevant to your particular situation. If you are looking for CPE, just a reminder that you need to stay connected to the GoToWebinar platform for the entire duration of this presentation. Participants must answer 75% of the polling question. Today we are going to have 6 questions, so you need to answer at least 4 of them. And the participant course evaluation, which is in the handout section of the control panel, should be downloaded, completed, and emailed to jtoshi@saxllb.com to receive your CPE credits. Again, this webinar is being recorded, and the slides and a recording of this webinar will be emailed to you within 24 hours of this presentation. So with that, I would like to introduce you to our presenters. We have Lisa here, who's going to talk to us about state, trust, and gift tax area. Louis is going to walk us through any updates on the 1040 side, and then Tyler is going to talk to us about business updates. So a brief agenda which we are going to go over and discuss certain items today. We are going to start off with the New Jersey BATE, what has changed from 2021 to 2022. We are going to talk about New York Business Pass-Through Entity Tax, the New York City PTET. A lot of questions we are getting from our clients, about worthless investments and virtual assets or cryptocurrency. So we'll briefly talk about that as well. Business planning, state trust and gift taxes, and then the 1040 tax update. So with that, polling question number 1. What NFL team has played in the most consecutive Thanksgiving games? We'll give you a few seconds. And we'll close the polling question in about 5 seconds. Well, I think the correct answer is the Detroit Lions. So we'll get started with the New Jersey BATE updates on what's different, as I said before, for the year 2022. The election for 2022 must be made before March 15, 2023. If you were required to make prior estimated payments, then you should have made the election already, because you cannot make the payments without making the election. The form itself is due on March 15th, and you get a 6-month extension period. The major change here is that the tax rates have changed, and they have brought down the ceiling when the highest tax rate is effective. So in prior years, you hit the highest tax bracket of over $5 million, the highest tax bracket at 10.9% once you were over $5 million. This threshold has now come down to $1 million. So once the income is in excess of $1 million, you have to pay a tax rate of 10.9%. What also has changed is the computation of the BATE tax. For resident owners for 2022, what is considered is both the New Jersey source income and the non-New Jersey source income from the K1. So if I am a resident shareholder and I get $80,000 from New Jersey source and I get $20,000 from non-New Jersey source, now the BATE will be calculated on my entire income of $100,000. This is different from prior year, where only $80,000 or my New Jersey source income was considered. For non-resident owners, New Jersey source is only considered in this calculation. The change for the S corporation is that only New Jersey source income will be calculated. In prior years, I think New Jersey was going back and forth between the one-factor formula and the three-factor formula. So for 2022, they are back on a three-factor formula. So what that means is that your K1, S Corp K1, is going to have different amounts than your New Jersey PTET K1, because one could be on a single factor formula, and then your BATE calculations will be done on a three-factor formula. So just keep that in mind when you're looking at your year-end calculations. Some good news also with all these changes is that the non-resident withholding is no longer required for BATE electing partnerships. In the prior years, you had to make the BATE payments as well as the non-resident withholding payments. So you were kind of doubling up on what needed to be paid to New Jersey, resulting in large refunds later on. Now on S corporations, the BATE credits received are no longer trapped in the return, and you are now eligible for a refund. And I already went over the tax rates with you for 2022. Moving over to New York pass-through entity tax. The election for 2022 was due on September 15th of 2022. The election for 2023 is due on March 15th of 2023. The election will open up on January 1, 2023, so you will be able to make the election for 2023 then. What remains unchanged at the partnership level is you still have the resident pool, which consists of the New York source income and the non-New York source income. That means both the incomes are considered when you're doing the withholdings or making the PTET payment. The non-resident pool consists only for New York source income. A major change for the S corporation from 2021 to 2022 is that New York has created something called the electing resident S corporation, which means that the S corporation certifies at the time of filing its return that all its shareholders are residents of New York, and then the PTET will be calculated for these entities on both New York and non-New York source income. New York came up with some additional guidance after we all filed the tax returns for last year on how the add backs would work for the PTET tax that is being paid. So this is just a brief outline of what New York guidance says, but I think it will be more helpful if I go over the example on the next slide. So let's say, for example, I paid $100,000 as estimated tax payments for 2022, which is the PTET year. On March 15th, I filed the tax return, but the actual tax due is $80,000. That $80,000 is allocated to all my partners or shareholders as PTET credit. So in the past, what we did was we passed out the $80,000 as credit to all the members and partners, and then the individual added back the $80,000 on their New York return. Now, in addition to that, what New York wants you to do is at the partnership level, you paid $100,000 as estimated tax payments. $80,000 was your tax due. So the refund which you are eligible to receive in 2023, you actually have to add it back as on your IT 225 as an add back. So in effect, you're adding back the $100,000 in total between your partnership and your individual tax return. On your partnership, you're adding back the refund which you're supposed to receive of $20,000, and on the individual return, you are adding back $80,000. So when you're doing the year-end planning, just keep in mind that you take the add back, assume the add back of 100% of whatever the estimated tax payments you have made. This slide just goes over the tax rates which are applicable for 2022. What is new for 2022 is New York City also came up with its own pass-through entity tax. And this was effective for 2022, January 1. The election is due March 15, 2023. And only for 2022, the election can be revoked before March 15, 2023. Elections for 2023 are also due on March 15. So on March 15, you have elections for 2022 as well as 2023 due. The change here is for 2023 and moving forward, the election is not revocable once you make it. the ability to make the election will open up on January 1 based on the website instructions as of now. So there are certain partnerships and S corporations who may elect into this New York City PTET, and they are called as eligible city partnerships or eligible city resident S corporations. So what is the eligible city partnership? Eligible city partnership is a partnership that has elected to participate in the New York State PTET, as well as is not publicly traded and it has at least one member or partner that is a city resident. Eligible city resident S corporations are S corporations that have also elected for the New York State PTET. So you need to elect for New York State PTET if you want to elect for New York City PTET. And then the requirement here, which is key, is that only city resident individuals are the shareholders of this S corporation. The tax rate at which the New York City PTET taxable income will be taxed is at 3.876%. The definition of taxable income is it will consist of all your income, gains, losses, and deductions. For 2022, no estimated tax payments were required, but the taxpayer will be able to make estimated tax payments before December 31st, so that, if you're a cash basis taxpayer, you can take advantage of the deduction by paying it before December 31st. Going forward for 2023, you will be required to make quarterly estimated payments of 25% each on March 15, June 15, September 15, and December 15th. The forms are not out as yet, so we don't know if the overpayment from 2022 can be applied to 2023. So for now, don't assume that it will be applied and make a huge payment so that you think that the overpayment could be applied. We are not sure at this point how it's going to work. The taxpayers will receive the New York City PTET credit on Form IT 653, and then you will still need to make an additional modification on your Form IT 225 for the amount of the credit claimed. So I just want to talk about, worthless investment, and with respect to all the virtual assets or cryptocurrency. We are hearing a lot about some of the exchanges like Voyager, FTX, and Celsius, going into bankruptcy. So what does that mean? So capital losses, as you know, can only be offset against your capital gains, and any excess can be carried over. Maximum, you can deduct $3,000 in a year, and everything else is carried over to future years. What happens if you think that your investment is worthless? So what IRS says is that a deduction is only allowed when the investment is totally worthless. You cannot claim a deduction if it is partially worthless. So in case of bankruptcies, losses can be claimed only when it is certain. Now, in most of these cases, as we know, we don't know how much funds will be recovered or if they will be recovered. So as of now, the taxpayers may need to wait and watch that what do these bankruptcy proceedings come out with, that, are you getting something against your investment or you're getting nothing? So there could be a possibility that you may even need to file an extension till you get more clarity so that you actually take the loss in the year when you are really sure that you're not getting your funds back. These losses are claimed on your 8949. In the year it becomes clear that you are not going to get any of your funds back. Another area, and where some of this worthless investment can be treated as a non-business bad debt, but there are very, very stringent provisions on what could be a non-business bad debt. This only applies if it is a debt, right? It cannot be investment of any other kind like stock, commodity, coin, or token. So first of all, you will have to go to the lending platform, read your agreements. For example, in Celsius, what exactly they define, are you loaning the money to them? Is it a debt? In that situation, there could be a possibility, and we will have to look at your particular situation, but there could be a possibility that you could deduct it as a non-business bad debt. Next slide, please. If it is deemed to be worthless and it is classified as a non-business bad debt, the loss can be deducted as a short-term capital loss. As I said before, you will have to read the terms and the conditions and the language of the website very clearly, how the note or your worthless investment was defined and what kind of agreement you had with these exchanges. With that, we go over to polling question number 2. What is the most common area code used in New Jersey? We're going to close the polling questions soon. Can you please close the polling question? Thank you. It is 973. With that, over to Tyler to go over some of the business planning.
All right, thank you, Shivani. My name is Tyler Goodspeed, and I was going to talk to you about some business planning. And so I'm going to start off by going over the cash versus accrual method and ways for taxpayers to shift income during this last 2022 year. So cash method is allowed if annual gross receipts for the past 3 tax years are under 27 million for tax years beginning in 2022. This is estimated to be 29 million for 2023. So what you're doing is you're going to look at your past 3 filed tax returns, and the average of your annual gross receipts on those tests will determine whether or not you can become a cash method taxpayer or stay a cash method taxpayer. Some ideas for shifting income and deductions: you can postpone billings until next year, accelerate deductible expenditures into this year. To increase recognition of expenses for the current year, taxpayers could consider paying invoices received before year end and even prepaying some expenses where feasible. However, you may want to do the opposite. Let's say if Congress was consider raising top individual capital gain and corporate tax rates. In this case, accelerating income and deferring deductions into next year would be the smarter route. Just a note for cash method taxpayers: prepaid compensation must be prorated over the period in which it applies. All right, next slide. All right, for accrual method taxpayers, acceleration of expenses is slightly more difficult for accrual method taxpayers. Expenses generally aren't deductible until property is delivered or services are performed. So an idea of shifting income and deductions for accrual is if tax rates are expected to be higher next year, taxpayers may want to delay some deliveries or the performance of services. Some special circumstances: prepaid expenses may be deductible in the current year when taxpayer reasonably expects the property or service to be provided or performed within 3.5 months after making the payment, or if the recurring item exception applies. Now, that recurring item exception is when economic performance occurs within 8.5 months after the close of the tax year. This exception must be consistently applied for a type of item or all items from 1 year to the next. So it's unlikely that the IRS will approve a switch from that method to generate like a short-term tax advantage. You're kind of stuck with that way of reporting if that's what you choose to do. All right, next slide. All right, timing of year-end bonus payments. This is an area where both cash and accrual basis employers have some opportunity to time deductions. Cash basis employers deduct bonuses in the year in which they're paid so they can time the payment for maximum tax effect. Accrual basis employers deduct a bonus in the accrual year when all events related to it are established with reasonable certainty. Must be paid within 2.5 months after year end. All right, next slide. Depreciation and expensing. For starters, we're going to talk about bonus depreciation. We've been enjoying this 100% deduction allowed for quite some time now, but it ends in 2022. You can see that we are going to gradually lose this bonus depreciation up until 2026. So if you need to fully expense any equipment or vehicles, now's the time to do it. Because in 2023, it is dropping down to 80% deduction. Special note for bonus depreciation. In Pennsylvania, New Jersey, and New York, bonus depreciation is not allowed. So this is an income add back for the states. So you can be doing wonderful on the federal return. You drive in a loss down really low, but then you can get caught with the states having that add back. Seen it plenty of times. Bonus depreciation is special because you are actually expected to take it unless you elect out of it. So you need to, if you wanted to elect out of it, let's say just for planning purposes, it's more beneficial for you to be out of bonus depreciation. You need to elect out of each specific category of income. So you need to elect out a 5-year, 7-year, 10-year, 15-year property. You have to specifically say, you know what, this whole blanket category, I'm electing out of it. All right, 179. 179 is limited to your taxable income. So you could only take as much as you have income to offset. Something special for 179 though, you can take as little or as much, or as little as you want. So let's say you have a 50,000 piece of equipment. You don't have to fully expense it. You can take $25 of Section 179 if you wanted, or you can take the full amount. So 179 is great for tax planning purposes. Next slide. For 2023, the maximum amount of 179 that can be fully expensed is $1,160,000. That limit phases out dollar for dollar once the amount of 179 property placed in service during tax year exceeds 2.8 million. This you would also want to watch for state add-backs. New Jersey only allows 25,000. New York State and New York City conform to federal law except for SUVs. So New York and New York City, they will allow your Section 179, just not anything that you've taken for SUVs. Pennsylvania allows Section 179 for C Corps, but they don't for 1065s or S Corps. It's only 25,000 for 1065s or S Corps. I made a little chart here for you comparing bonus depreciation in Section 179. In the past, bonus depreciation was only for new property, but they have allowed it for new and used property over the years. You can see that it's only 80% of the cost of qualified property for 2023, and that's going to keep phasing down until 2026. Go ahead and go to the next slide. I would like to shift over to 163J and business interest deductions. We have some big changes here this year for the 2022 period. The deduction limit on business interest does not apply to businesses with 3-year average gross receipts of 27 million or less for 2022. And this is done the same with finding out whether or not you're allowed to do cash versus accrual. You look at your past 3 years tax returns, just the gross receipts, and take the average of those amounts. And if you're under, you don't have to do this limitation. Now, interest that is limited can be carried forward indefinitely until you have enough income to take that expense. 2 new changes within this IRC 163J. Businesses are required to amortize research and development expenses over a 5-year period. And the biggest change, the limitation on business net interest deduction is reduced to 30% of earnings before interest and taxes, instead of earnings before interest, taxes, depreciation, and amortization. Now, this is a big one. So I'm going to show you an example next. All right, I'm going to do a side-by-side comparison of a 2021 year and a 2022 year, all with the same income items, same deduction items. You start with 100,000 of gross receipts. Interest expense is 30,000, depreciation is 50,000, amortization 5,000. We have a net income of 15,000. Now, we need to have some add backs for adjusted taxable income when determining the limitation. So we're going to add back interest expense, add back depreciation, add back amortization, and you have an adjusted taxable income of 100,000. This allows you to take the full interest deduction. And so taxable income stays at 15,000. Now, if we have all the same income items for 2022, you can see that we're not adding back depreciation or amortization for adjusted taxable income. So our adjusted taxable income is 45,000, and it's limiting our interest by 16,500. So taxable income will now be 31,500, and that interest will just be carried forward until we have enough income to take the deduction. All right, next slide. All right, payment of deferred payroll taxes. Employer and self-employed individuals could defer payment of 6.2% of employer share of Social Security taxes on employee wages. The deferral period was from March 27th, 2020 to December 31st, 2020. Payment of deferred taxes, 50% of the deferral is required to be paid by the end of 2021. That remaining 50% is due by the end of 2022. So just note that you need to get that paid by the end, or this month actually. All right, next polling question. Which of the team players received Rolls Royces for their World Cup win? All right, gonna give a couple more seconds. I actually don't know the answer to this one. I'm guessing Saudi Arabia.
Yes, it is. Tyler, before you go on, I do have a couple of questions in the queue, which I'll just take right now. One, I think a lot of people are asking about the slides. Yes, they will be downloadable and you will receive an email link with the recording of this webinar. There was also a question on, on New Jersey bid for partnerships. What about part year resident calculation? So New Jersey actually addresses that question on its website, saying that what happens if you're a part year resident and a part year non-resident. So it says that if you are a part year resident individual, the member will be treated as a full year resident individual, and the bait will be calculated on the member's entire share of distributive proceeds. So hopefully that answers your question. It's right from the New Jersey website as FAQ. Thank you, Tyler. You can continue.
All right. So now I wanted to get into qualified business deduction. This is still going on. This is continuing, but QBI deduction is actually set to expire in 2025. So eligible taxpayers can deduct up to 20% of qualified business income through 2025. The deduction can't exceed 20% of the excess of the taxpayer's taxable income over net capital gain for the year. Trades or businesses involved in the performance of services do not qualify for QBI deduction unless the taxpayer's income is below a phase-out threshold. All right, now that phase-out threshold for 2023 is going to be $364,000 for married filing joint and $182,000 for married filing single, head of household, and single filers. Year-end tax strategies for this: taxpayers with income near the threshold for this year may benefit from accelerating deductions or deferring income so their taxable income falls below the threshold. Also, if the taxpayer is well below the threshold this year, but expects to exceed it next year, consider pulling more income into 2022. Extenders and expiring provisions. I've just brought over a list. I'm not going to read this whole list out to you, but you can see some of the provisions that are expiring at the end of 2021. All right, next slide. All right, this is important. Meals and entertainment are reverting back to their 50% deductibility in 2023. So 2022 is the last year for this 100% deduction. We're going back to normal. Provisions that extended through December 31st, 2024, via the Inflation Reduction Act listed below. All right, next slide. And here are some more provisions recently extended through December 2025. All right, and these are provisions that have recently been made permanent. All right, polling question number 4. Who was the first woman to win a Nobel Prize? Let's go ahead and give this a few more seconds. All right, Shivani, was that correct? I feel like I should know my history a little bit better.
Yes, it is.
All right, I'm going to pass it over to Lisa to talk to you guys about estate, trust, and gift taxes.
Thank you so much, Tyler. Hi, everyone. Good afternoon. My name's Lisa Mila, and I'm going to discuss the estate, trust, and gift taxes, talk about some planning strategies, as well as the current situation, as well as provide some year-end reminders. So with respect to the estate and gift taxes, what's the current situation? So the exemptions are still extremely high. So for 2022, the exemption is 12.06 million per person. For a married couple, that would be double, so 24.12 million for a married couple. And the annual exclusion amount, so this is the amount that you can give to anybody, any individual, relative, non-relative, without having a taxable gift. That amount is 16,000. We're set to have an increase in 2023 of the exemption, so it's going to go up. It's an inflationary adjustment up to 12.92 million per person, and then 25.84 million per couple. The annual exclusion is also going to bump up, so that's going to increase by an additional 1,000 up to 17,000. So just a note that this exemption is an aggregate amount that can be given away during life and then at death. And another reminder, so under the current law, this exemption is going to be automatically reduced beginning in 2026. Okay, so with respect to estate planning, what should we be doing now? Well, it's always important to revisit your current estate plan. So we suggest that you do that on a periodic basis. If planning was making sense before and you were in motion with a plan, it probably still makes sense to continue forward with a plan now. So there's a lot of non-tax reasons to proceed with estate planning, asset protection being one. So creditors, asset protection from creditors for beneficiaries. And then again, as I mentioned on the prior slide, this exemption is going to be dropping in 2026. So basically just another reason to maybe take advantage of the opportunity now with the higher exemptions. So if considering major transfers before year end, conversations that I've been having with clients is to also consider cash flow needs. You want to make sure that if you're giving away significant assets, that you still have the necessary cash flow to live that lifestyle that you're accustomed to. So it's going to really just be custom client by client based on preferences. So some simple estate planning ideas. Well, the easiest thing to do is take advantage of that annual exclusion I mentioned and gift away up to $16,000 to relatives, non-relatives, friends, anybody of your choosing. Also think about making payments for others for health and education expenses. If you make these directly to medical providers or educational institutions, they're not going to be treated as gifts. Another thing to think about would be funding college savings 529 plans. And you can do an acceleration and make 5 years worth of contributions in 1 year. And then when you would file a gift tax return, you would make an election to have that front-loaded contribution ratable over the next 5 years. Okay, so if you wanted to move forward with some more sophisticated planning rather than doing the simple estate planning that I just previously mentioned, we suggest that you speak with your trusted advisor, which would be Sax, and we would pull in experts from various disciplines to make sure that the plan overall is cohesive. We really like to take a collaborative approach. So we're going to bring in the necessary attorneys that are going to advise on planning opportunities and help with the legal instruments and documents that need to be drafted. The accountants, Sax will make sure that you're complying with tax reporting and accounting regulations. Financial advisors are going to ensure that the proper investment strategy complements whatever trust structure is decided on. And then with respect to trustees, so the trustees that are selected and are administering the trust, we're going to want to make sure that they're acting in the best interests of charitable and/or non-charitable beneficiaries. So again, like I mentioned, the advisor team should be taking a collaborative approach with one another, and then also, if there's a charity involved, make sure that they're coordinating with them throughout the planning process as well. Okay, so I'm going to talk about some year-end charitable gifting strategies. So I'm going to get into the first 4 in the next couple of slides, but I'm just going to kind of run down the list and talk briefly on the last 3 on the list here. So this is ranked from basic to most sophisticated in terms of charitable gifting strategies. So the first being, again, very basic, simple, annual cash donations and donor advised funds, in-kind donations of appreciated assets, QCDs from an IRA, and then testamentary bequests would be, weaved into a will or estate planning documents, charitable annuities, and then the most sophisticated being charitable trusts. And there's a variety of charitable trusts, options. Next slide. Okay, so to speak a little bit on annual cash donations. So annual cash donations are extremely attractive for the simplicity factor. So there's no valuations, not subject to IRS challenge. If you have substantiation, very easy to implement. There's no costs associated with title transfer. And last time I checked, every charity is going to accept your cash if you want to give it to them. There's the I just want to reminder, in 2021, there was the 100% limitation. There was no limitation with respect to AGI, but starting now through 2025, it's actually the limitation is 60% of adjusted gross income. So the downsides, though, with just doing annual cash donations, you could be missing opportunities for larger income tax deductions in a year and estate planning techniques and options. And then charitable organizations may not be able to plan for donations and spend on behalf of specific charitable causes. So that's, again, just another downside of simple annual cash donations. Next slide. Okay, so let's talk a little bit about donor advised funds. So in having conversations with clients, this is very beneficial if you're expecting a large income event in 1 year. So a donor advised fund allows for the donor the ability to make a large, significant charitable contribution in 1 year, when income is expected to be much higher than usual. And then you can spread out the charitable grants over time while getting that tax deduction in the specific year. You can put highly appreciated investments or cash into a donor advised fund, and then in some cases, privately held investments as well. This is a great way to leave a legacy for family and to continue to make grants after death as well. Okay, so let's talk a little bit about stock contributions to charity and then things to kind of keep in mind when doing so. So we recommend that you target stock that's been held for more than 1 year and that the price of the stock is appreciated. So if ordinary income short-term capital gain property is contributed to charity, there is going to be a limitation. So it would be limited to the property's fair market value less the amount that would be treated as income. So essentially that ends up being the donor's basis. So just something to be really mindful and cognizant of when targeting stocks to contribute to charity. So again, we recommend long-term capital gain property. And then when that contribution happens, the donor's not going to have a recognition of that realized gain. So if your donation is limited, there is a carry forward element as well. So there can be a carry forward for 5 years. Something important to keep in mind that if the charity is accepting stock contributions, they need to have a brokerage account in order to accept the shares. And there might be a policy with respect to the board on how those investments get handled once they're received. All right, next I'm going to talk a little bit about qualified charitable distributions. So in order to do this, the donor must be 70 and a half or older. The donation needs to be directly from the IRA to the charity. There is a maximum amount, which is $100,000. This can be done, you can donate cash or stocks. This satisfies the required minimum distribution amount. You have to note though, however, that you can't donate to a foundation or a donor advised fund. The amount of the QCD is not included in income for the year, and it's not a deductible charitable expense. And then the donation is not actually subject to AGI income limitations. Okay, I'm not going to walk through this whole chart, but as you can see, based on the type of contribution, the AGI limitations are different. However, if there is any unused donation, there is the carry forward element, and that can be used over the next 5 years, regardless of the type of the contribution. Okay, so switching gears here a little bit. This is just really a reminder that the estates and trusts, as taxpayers, the tax brackets for estates and trusts are extremely compressed. So what does that mean? So estates and trusts, they reach the highest bracket very quickly, as you can see here by this chart. So once the income hurdles $13,450, you're in the 37% bracket. Next slide, please. Okay, another reminder here. So estates and trusts are subject to net investment income tax as well. So the NIIT is 3.8% on the lesser of undistributed net investment income, or the excess of the adjusted gross income over the dollar amount at which the highest tax bracket for an estate or trust for that tax year. So what does that mean? So once you get over that very low hurdle that I described on the prior slide, the $13,450, this 3.8% surcharge kicks in. So what encompasses the net investment income for purposes of this tax? It'll include interest, dividends, annuity amounts, royalties, rents, unless those are considered derived from a trade or business. And in that case, the net investment income tax would not apply. Also note that the net investment income tax would apply to net gains from the disposition of property as well. So again, just to reiterate, if the trust and estate's earning income and it's staying in the trust, is not getting distributed out to beneficiaries, you could be in the highest rates pretty quickly, and then also subject to this net investment income tax. Next slide. Okay, so what to do to help mitigate capital gains taxes? We can take advantage of tax loss harvesting. So the opportunity to sell positions at a loss and then generate a tax benefit. So we recommend fiduciaries are reviewing their portfolios and taking advantage of this. So if they're if the trust or estate is anticipating significant gains, reviewing positions, seeing if there's any unrealized losses to mitigate these gains. So as I believe Shivani maybe mentioned earlier, the maximum deductible net capital loss is $3,000 per year after offsetting any sort of capital gains. This is true for estates and trusts. And then there is the carry forward element to future years as well. So anything unused above that 3,000 will get carried forward. So now on the flip side, maybe tax gain harvesting makes sense. So the opportunity to sell positions at long-term capital gains. So we recommend that fiduciaries review, again, the portfolios, see if there's any unrealized gains that make sense for a year end to capture any appreciation in a potentially lower tax year with lower rates. And this is just a reminder, so that's 20% long-term capital gains. So you could be utilizing that rate. Okay, so some other year-end reminders for fiduciaries. So non-grantor type trusts, simple trusts, require annual payouts by fiduciaries to beneficiaries. So this is just a reminder to take care of that before year-end. With respect to non-grantor complex trusts, the trust instrument says that the distributions can be discretionary. So it might make sense to make distributions of income, even though they're discretionary, and then this way shift the income to beneficiaries who are in lower tax brackets, and then this way incur less taxes on that income being generated. A lot of charitable trusts or grantor type trusts, and when I say grantor type trusts, meaning like grantor retained annuity trusts, require annual annuity payments or distributions to charity. So this is just a reminder to take care of those by year end or shortly thereafter. There is a 65-day rule for estates and complex trusts. So you're allowed to make distributions after 12/31 within a 65-day period, and then it counts as a distribution from the preceding year. One other thing, oh, can you just go back to the slide? Two other items I want to just mention before we advance to the next slide. So there is the 1041T election for terminating estates and trusts. So what is this? So for any trusts terminating by year end, it's important to see whether or not any sort of estimated tax payments were made to the IRS. And then there is this option to file this election form to then shift the estimated payments from the estate and trust to the beneficiaries. And there is a strict window. Again, it's within the first 2 months of the year to take care of that election, so that then that payment, rather than getting a significant refund on the estate trust level, it then shifts to the beneficiary, and then they can count it on and report it on their tax return. And then one last thing to think about, and a reminder for trustees, is it may make sense, based on income being projected for the year, to accelerate or defer expenses before or after year end. Next slide. All right, so I'm going to end here with this last reminder regarding inherited IRA distribution requirements. So it's really important to revisit any sort of inherited IRAs. The IRS has provided relief that there's not going to be any excise tax or penalty assessed in 2021 or 2022 if RMDs were not made from IRAs inherited. However, annual RMDs are going to be required to be taken in 2023 with a full distribution then being required by the end of the 10th calendar year following the decedent's death. So this is just a reminder that the IRS has provided relief for 21 and then this year, but then not starting next year. And with that, I'm gonna transition to the next polling question, number 5. Okay, so which 2 countries have not missed one of the modern day Olympics? Couple more seconds and then we'll close the poll. Everybody get their votes in. Everybody wants to get credit. USA and Italy and Greece and Australia are tied. I have no clue what the right answer is.
It is Greece and Australia.
All right, so with that, I'm going to turn it over to my colleague Lou to get into some individual tax planning and year-end reminders.
Thank you, Lisa, and great job. Great job, Shivani and Tyler as well. So I'm going to touch base on some updates on the 1040 side and go into some year-end planning things for hopefully save a couple bucks before the year is over. So a couple of things here. So this is the updated tax brackets or the rate change or the income thresholds for 2022 and 2023. So this is for a single filer here. So the percentages are the same: 10, 12, 22, 24, 32, 35, and 37. Those did not change. But if you compare the 2022 side to the 2023 side, the tax rates or the income levels went up. And this was adjusted for inflation. So there's a possibility, obviously, if you're making the same amount of money this year and next year, your overall tax bill can go down because the brackets went up. So, but keep in mind, so we are on a graduated tax rate system. So if you're in, let's say, the 24% tax bracket between 89,000 and 95,000, all your income is not taxed at 24%. Only the income between 89,000 and 95,000 is taxed at that. And then everything below that is taxed at the 22% and the 12% on those income levels. So those are the updated single tax brackets. So you see the 37%, there was an increase from 2022 to 2023 of $38,000. You want to go to the next slide, please. And here's the same thing for married filing jointly. You have the same rates: 10, 12, 22, 24, 32, 35, and 37. The rates are obviously, the income thresholds are a little higher for a married filing joint taxpayer. So you see the max tax rate is $647,000 versus single taxpayer, it's only $539,000 for 2022. And you see the difference in the max tax rate from 22 to 23 is $45,000. And this was adjusted for the inflation that we're going through. So they raised the tax bracket. And same thing here. Here are your updated standard deduction rates, standard deduction amounts for 22 and 23. So year over year from 22 to 23, it's going to go up $900 for a single filer, and for a joint filer, it's going to go up $1,800. And for head of household, it's going to go up $1,400. So if you're not itemizing, this is your minimum deduction that you're going to get on your return for the standard deductions. For a single taxpayer, they'll get a deduction of $12,950 this year for not itemizing. So next slide. So these are some couple quick points on itemized deductions. So to take a medical deduction on your federal tax return, it has to be over 7.5% of your adjusted gross income. So if you make 100 grand, you would have to have at least $7,500 worth of medical expenses for that to be an itemized deduction. So anything above 7,500, that will start to add to your deductions. It used to be 10%, but they changed that a couple years ago and they made this permanent, that the AGI cap is 7.5%. SALT cap, the state and local tax. So that was changed a few years ago with the TCJA, and that still remains at $10,000. It has not changed. There have been talks about it in the past, but nothing has been pushed through. So for now, that remains the same going forward. Just keep in mind that there are some workarounds. I know Tyler discussed that earlier, such as the New Jersey BEAT and the New York PTET, where you can get a workaround and you could get a deduction on the federal level and pay the taxes on the business side. So those are he mentioned New York and New Jersey, but keep in mind, if you do business in other states, most of the states have their own PTET or BEAT system where you could where that applies as well. So definitely reach out to us if you're doing business in these other random states where you may be able to make an election to have a PTET tax withheld. The last year in 2021 and 22 with the CARES Act, if you did not itemize, they would let you take a above the line deduction of $300 or $600 if you were married. That is no longer. So if you're not itemizing your charitable, you will not get a benefit for making your charitable contributions. And also, the AGI limit this year for cash donations is back down to 60%. The past 2 years, they raised it up to 100% through the CARES Act. So that's going back down to 60% in 2022 and going forward. So so net operating losses. So if you have a loss, it carries over as a net operating loss. So there's some updates to that. So with the CARES Act, tax years ending 12/31/2017 before January 1st, 2021, you have to carry back your NOL. You're required to. If you had a loss on your tax return. You could have made an election to elect to carry it forward, and it carries forward indefinitely. 2021 and beyond, losses arising after tax year December 31st, 2020, you cannot carry back your losses any longer. So starting January 1st, 2021, if you have a loss on your tax return, you cannot carry it back. It has to be carried forward. So this originally changed with the TCJA, where they said you cannot carry back any losses. Then COVID happened, and with the CARES Act, they changed that, where they gave you a 3-year period where you could carry it back. Now you can't carry it back any longer. You have to carry your losses forward, going forward. So losses are from 2018 through 2020. They carry forward at 100%. Losses happening after January 1st, 2021, there's a limitation of 80%. So I'm going to touch base on what exactly that means on the next slide here. So your losses, if you have a loss in the current year, it carries over as an excess business loss. So in the prior years, 18, 19, and 2020, there was no limit of how much of a loss you could take. If you had $1 million loss, you could take the $1 million loss. The $1 million loss carries over to year 2, and your starting point in year 2 would be negative $1 million of income. Now, going forward, tax years after 12/31/2020 and before January 1st, 2026, you're limited of how much of the loss you can take. So if you have $1 million loss and you're a single taxpayer, you can only take $270,000 of that. So now keep in mind that's trade or business income. So if you have W-2 wages, interest, dividends, those don't offset that. They're in separate buckets. So if you are expecting a big loss, don't assume that it's going to wipe out all your taxable income this year. It may be limited due to the excess business loss limitation. And if you're a married taxpayer, you're limited to a $540,000 loss limitation. And keep in mind, basis limitations, at risk, and passive loss rules all still apply to this. All right, now I'm just going to go over some limits for updated limits for 2022 and 2023. So your Social Security, the max wages for 22 is $147,000, and 2023 is $160,200. So what exactly does that mean? So in 2022, once you, on your wages or your W-2, once you hit 147,000, your employer stops withholding Social Security. If you have two jobs, obviously both jobs are going to withhold up to 147,000, but when you file your tax return, you do get a credit for the additional Social Security taxes or the excess Social Security taxes that you paid. The rates are still the same at 6.2%. So for 2022, the max withholding, Social Security withholdings is $9,114. In 23, that amount's going to go up to $9,932. The Medicare tax is 1.45%. That has not changed this year or next year. So if the 6.2 plus the 1.45, that gives you the 7.65%, which is 1/2 of the Social Security tax of 15.3. So that's the employee's responsibility. The employer pays the other 7.65. If you're self-employed, you pay both halves of it, the employee side and the employer side. Also, there also is the additional Medicare tax of 2.35%, which is additional 0.9% for single filers if you make over 200,000, or married if you make over 250,000. So they stop withholding your Social Security at 147,000. Your Medicare tax they still withhold that up until 200,000, but after the 200,000, the rate goes from 1.45 to 2.35%, and there's no max on it. And those percentages did not change for 2022 or 23. Just going to go over the updated your retirement contributions and the max that you can make. So for 2022, the max retirement contribution is $20,500, and that goes up to $22,523. Keep in mind the catch-up for anybody over 50 years of older is $6,500 for a max of $27,000. For 2023, the catch-up is $7,500 for anybody over 50 years or older. So you could contribute up to $30K to your IRA. A couple other retirement options, depending on what plan you have, or you're self-employed or something like that, you may be able to do different things here. So a simple plan is $14,000, that did not change. Your traditional IRA contribution is $6,000, it goes up to $6,500 next year. The max FSA is $2,850 this year, and that goes up to $3,050, a $200 increase. The max SEP this year is $61,000, and that goes up $5,000 to $66,000. That's roughly off about $305,000 of income, or $330,000 of income next year. Just want to go to the next slide. So next up is payment apps. This has been a hot topic going around. So these payment apps such as Venmo and Cash App, they must report all transactions of $600 or more on Form 1099-K for goods and services. So their threshold this year is $600. The prior reporting threshold was either 200 transactions or gross payments exceeding $20,000. So does that mean you're going to get a 1099-K because you're transferring money through Venmo? It's really not clear. It depends. So obviously keep in mind, money received as personal gifts or reimbursements for expenses such as splitting a bill is not taxable. So if you're at a restaurant going out to dinner and somebody Venmos you half the bill, no, that's not a taxable transaction. And it's not taxable. Does that mean Venmo may think it is and may issue a 1099? It's possible. If that's the case, when you get it, you have to reach out to them and see if they correct it. So make sure you check your mail, the end of January, February, to see if you're getting these 1099Ks from these transactions. And keep in mind, a lot of places don't mail 1099s anymore, so you may have to log into the app to check. And if they do issue you one incorrectly, you should call them to see if they correct it. If they don't correct it, there are other options. Option B is obviously we report the income on your return, and then we do a subtraction or an adjustment, and we back out the income to net at zero. And we'll put a footnote on the return explaining what happened. But keep in mind, though, most people use Venmo to transfer money through family and stuff like that, but there could be other things included in there. Let's say you sell a baseball card or something like that. That is considered taxable income, where that amount would have to be reported on your tax return as income. So as you know, all income is reported and taxable. So be on the lookout for that. Just want to go to the next slide. Yep. So I'm going to go over some year-end tax strategies where you hopefully save a couple bucks at the end of the year. So the biggest one is to review your retirement accounts to see where you are, or if you're using a broker, to make sure they didn't, realize huge capital gains and stuff like that. Obviously, you don't want any surprises at the end of the year when we file your tax return. So the best thing is to obviously let us know sooner rather than later. You may have unrealized losses that you may want to realize to offset some of your capital gains to reduce that. So that's a common thing that people say, but I always like to say, don't just go out and start selling all your stocks that are in negative positions to offset your income. Obviously, have an outlook of the market and stuff like that. If you think the market's going to stay flat or continue to go down, yeah, you should probably sell them and rebuy them. But if you think the stock's going to go up in the next couple of weeks or something like that, you may not want to sell it. So it's all depending on your opinion. But also keep in mind that if you sell the stock at a loss, there's something called the wash sale rule. You have to wait 30 days or 31 days to rebuy back that stock. If you don't wait that period, your basis gets adjusted and it gets rolled over to your new basis, so you can't take the loss. So be wary of that, of the wash sale rules before you start flipping stocks and stuff like that to realize losses. You can't sell a stock today at a loss and buy it back tomorrow. So if you have any questions on that, let us know. Another good idea to save money on your taxes is obviously defer as much income as you can. So with that being said, maximize your retirement accounts. I did discuss them a few slides earlier. If you're over the age of 50, make sure you're doing the catch up to defer as much as you possibly can. The next strategy is Roth IRA conversions. It's typically, that's not a tax saver. It will increase your tax. So there are some unique tax situations or certain situations where you want to do a Roth conversion. So what that is you're taking money from a traditional IRA and you're rolling it over or converting it to a Roth IRA. Traditional IRA is a taxable account. You put it in there pre-tax. When you take it out, you pay tax on it. They both grow tax-free, but the Roth IRA, when you withdraw it, you don't pay tax on it. So a situation where you may want to consider a Roth conversion is when your income is down this year, or if you have a loss, you may want to take some money out and do a Roth conversion. If you're at a negative income position, you'll take it out. You can net at zero, possibly not pay any tax. You convert it to a Roth IRA. It obviously grows tax-free, but when you withdraw it, there's no tax on it, which can be huge. A couple other big things at the end of the year to save some money is charitable donations. So For individuals, you could donate up to 60% of your income to charity of your adjusted gross income. If you donate, that's cash donations. If you donate anything above that, they carry over for 5 years. Same thing for capital gain property. It's 30% of your adjusted gross income you could donate. Anything over that will carry over for 5 years. Another big thing is a donor advised. Oh, sorry, let's go back one more slide. Another big thing is a donor advised fund, which if you want to make a large donation in year one to receive the benefit for it all up front in year one, you donate to a donor advised fund, they hold the money, and they give it to the charities over the X amount of years. So that's a good thing. You take the deduction all in year one. The charity doesn't get all the money in year one. They get it over a certain period of time. And another big one is a qualified charitable distribution. So to do this, you have to be 70.5 years old. And what this is you're taking money directly from your IRA, and instead of the IRA writing the check to you, they're writing the check directly to the charitable organization. So this satisfies your RMD requirement, and it's coming out pre-taxed, or you're not paying income tax on it. It's going right to the charity. So if you're single, the max you could do is 100,000. If you're married, the max you could do is 200,000. 100,000 for husband, 100,000 for spouse, for a $200,000 donation to the charity. Keep in mind, most states do not follow this. New Jersey does not follow this. So in this situation, if you do 100,000, it will not be taxable for federal tax purposes, but for New Jersey tax purposes, you will be paying tax. Next slide, please. A couple other things you want to think about maxing out before the end of the year is your HSA and your FSA, your flexible spending account. So for 22, for a single file, the max is $3,650. For a family, it's $7,300, and that goes up to $3,850 in 2023, or $7,750 for a family. And there's also a $1,000 catch-up for anybody 55 years of age or older. Keep in mind, just to have a HSA, you have to have a high deductible plan. So if you do have a high deductible plan, you should definitely look into this, as this can be a huge tax savings for you to put that money into a medical expense and pay all your medical deductions or your medical expenses. Another thing up here is the QBI deduction. Tyler went over that earlier in his slides. You can get a 20% deduction off your income. Keep in mind, if you're above the 364,000, starts to phase out. So you're gonna have to factor in your W-2. There's a calculation. You have to factor in your W-2 wages and stuff like that. Your trade or business. So maybe, hey, we have to take more payroll because you're not getting the full QBI deduction and stuff like that. So adding more payroll, you can get a bigger benefit. So that's something to discuss if you're in those limits. I discussed the NOLs and the limitations earlier. So keep in mind, if you have $1 million loss this year, and you have $1 million of dividend income, net you have zero income, right? But this year, no, you have the $1 million dividend income, but your loss is limited for a married taxpayer to $540,000. So you're going to have $460,000 of taxable income. So be on the lookout for that. If that's the situation you're going to be in, you're most likely going to have to pay tax there. Disaster loss. So for tax years 2018 through 25, you can only claim this loss if it happened in a federally declared disaster area. So if you're in one of these areas this year and you had a loss, let us know. We could discuss your options, and you could possibly get an additional itemized deduction for this. RMDs require minimum distribution. So the age limit now is 72 years of age or older. So what that means is once you hit 72 years of age, you have to start withdrawing money from your retirement accounts, your 401ks, your IRAs, and stuff like that, there's a chart off the IRS website, your age expectancy, and there's a certain percentage you have to take out based off your 12/31 balance of the prior year. And you have to do that for the rest of your life or until there's no money left in your account. If you do not withdraw from your RMD at the age of 72, there is a penalty. The penalty is 50% of the withdrawal. So if your RMD this year is, let's say, $50,000, the penalty will be $25,000 for not withdrawing. So make sure you guys are, checking in on your parents, your elder ones, to make sure they're doing it. As people get older in age, they tend to forget. It's possible to get them out of the penalty. There are ways. It's not a slam dunk. So it's a lot easier if you just take the withdrawals when they're supposed to be taken. If you did miss a year or two, let us know. There's steps that we could take to correct it, so the IRS doesn't come knocking on your door and sending you a letter for a 50% penalty. A couple other, there are some tax credits that are going back to their prior levels. So for instance, the child tax credit last year was $3,600 per child. Now it's going back down to $2,000. The child and dependent care credit returns to a maximum of $2,100 this year, instead of just $8,000 last year. And they're also adjusting the earned income tax credit for single files. That's a maximum of $500 this year. Next slide, yep. A couple of things here. Electric vehicles. This is a big thing here with gas prices the way they are. Everybody wants to get into an electric car, right? So a couple things. The credit's $7,500. That's what it was prior, but it's split into two different credits. You got $3,750 and another $3,750. So there's two parts to it to get the max of $7,500. Half the vehicle and the battery components must be manufactured or assembled in North America. And to be eligible for the other $3,750, a vehicle must have critical materials that were extracted or processed in the US or a country that we have a trade agreement with. And the final assembly must take place in North America for the vehicle to be eligible. So keep in mind, there is a website that tells you what vehicles get the credit. So don't just go off of what the salesperson tells you because they're trying to make a sale. They're going to tell you the car gets the credit. Not necessarily true. Reach out to us, let us know the car and the information, and we can tell you if you're going to get the $7,500 credit or the $3,750 credit. There also is income limitations on the credit now going forward. Only cars under $55,000 or SUVs, vans, pickup trucks under $80,000 are eligible for the tax credit. There also is an income threshold. So if you make, for single files, if you make over 150, head of household 225, or married, filing joint 300,000, you do not get the credit. Starting in 2024, there will be an option when you purchase the car up front, you'll get the credit then. Keep in mind, you have to buy the car or purchase the car. You can't lease the car to get the credit. So it has to be a purchase or a finance for the credit. And the requirements for the battery components or the critical materials go into effect January 1st, 2023. You want to hit the next slide? Now going forward, also there is a credit for used electric vehicles. So for you to get the credit for that, the vehicle must be under $25,000, the purchase price. The car must be at least 2 years old based on the original purchase date. Also, you have to buy the car, the electric vehicle, from a dealership. You can't buy it off, see an ad in the paper and buy it from somebody on the corner, right? You got to buy it from a dealer to get the credit for the used car. There's an income tax limit for this, or $75,000 for single files, $112,500 for head of household, and $150 for joint filers. And the used car vehicle only one per vehicle. So you get the person who bought the car, they could get the $7,500. The person who buys it used can get the additional credit. But the third buyer of the car will not. So obviously you could see the transaction history on the car, usually on Carfax and stuff like that. And this credit goes into effect January 1st, 2023. So if you're thinking about buying a used car, wait a couple weeks for the electric vehicle credit. Next slide. All right, a couple updates on more energy credits. So if you're getting solar panels from 2022 to 2032, they raised the credit to 30% of the cost of the solar panels. Prior is 26%. From 2023 to 2034, it's 26% as well. Keep in mind with the solar panels, you have to buy them. You have to purchase them. You finance them or whatever. You can't lease them. You know, if you see the ads, you don't pay anything for it or whatever. You don't get any credit for that. You actually have to finance it, pay for it up front, and then you get the 30% credit. Also, one thing I forgot to mention on the electric vehicles, if you do put a charging station in your home, the cost to buy that and install that, there is also an additional credit for you as well. So keep that in mind. Also, there is another thing that they updated here was the energy efficient home credit. So you could get up to $1,200 a year for the credit. It used to be a $1,200 lifetime thing. Now each year you get a maximum of $1,200 starting in 2023. So if you do an energy audit of your house, you get a $150 tax credit. If you replace windows, exterior windows, you get $250 per window, a max of $500. You could exchange replace 2 windows and get a $500 tax credit. And if you replace your furnace or hot water heaters and other things, it's a $600 credit. But keep in mind, these have to be energy efficient stuff. So they have a sticker on it. There's special guidelines. If you're thinking about, you know, replacing your air condition, yes, you could get a credit of $600 for doing that, but make sure it's energy efficient. There's a website that tells you the specs that it has to be for you to be entitled to that credit. And next slide, please. So a couple things I want to touch base with on New Jersey here is New Jersey does allow a deduction for medical expense. So it's 2% of your income as opposed to the IRS is 7%, the federal is 7.5%, and then you have to meet the thresholds of itemized deductions. So if anything over 2%, you get a deduction on New Jersey's return. So keep in mind, for the federal purposes, your health insurance comes out of your paycheck pre-tax. New Jersey comes out post-tax. So your health insurance that you pay for New Jersey is post-tax. You get a deduction for that, plus any out-of-pocket expense that you pay. You get a real estate tax deduction on New Jersey up to $15,000. If you don't own your rent, you get a deduction for that as well. So it's your total rent that you paid times 18%. That's your rent deduction you get on New Jersey, and that's limited to $15,000 as well. Keep in mind, New Jersey has various income buckets, so everything stays in a bucket. So I'll give you an example. If you have your partner in an S corp and your shareholder in you're a partner in a partnership, you're a shareholder in an S corp. The partnership has a $100,000 loss. The S corp has a $100,000 income. On the federal tax return, 100,000 loss, 100,000 income, you're netting at zero. New Jersey's different. New Jersey doesn't allow losses. They carry forward. You get to use it in the following year at 50%. So you'll pay tax on $100,000. The other income would be limited to zero. So you're going to have $100,000 taxable income in New Jersey. So keep that in mind. If you have an S corp and a partnership, you may have income tax. A couple other quick updates before we wrap it up. Go through it real quick. New Jersey allows a deduction for 529 plans, 10,000, 20,000 if you're married. If you have student loan interest, you deduct up to 2,500, but that has to be from an NJ class loan. And if you're in New Jersey higher education, you can deduct up to 10,000 for tuition costs. And that's it. And now I've got Sean.
Yeah, thank you, Lou. Before we go into the polling question number 6, there are a few questions in the queue which we'd like to answer since we still have about 5 minutes to go. So one of the questions was that since the deferred payroll taxes are due end of 2022 and December 31st, 22 is a Saturday, isn't it due then on January 2nd, 2023? Because these taxes were deferred and the IRS said that the tax needs to be paid by December 31st, you should have received a notice with the due date on when the tax is due. But I think what my thought is, if you're a cash basis taxpayer, you would want to pay it by December 31st to get the deduction. And if you were an accrual basis taxpayer, you still want to pay it by December 31st because in 2020, you did not take a deduction since it was not paid. And now you'll get a deduction only when this payment is made. So that's just my thought on it. There is another question. Lisa, I'm going to
Sure. Yeah, I'll take the other two questions, Shivani. Thank you.
Yeah.
So there was a question as to our opinion on using an IRA checkbook where an IRA owner is over 70 and a half and the IRA owner makes a check directly payable to charity. So yeah, this is a great option. You don't necessarily need to have a checkbook though. You could do it through like a wire automatic, bank transfer directly from the IRA to the charity. But yes, that is a good. The other question here I'd like to address, which I did not mention, but it's a great point. So when I was speaking on the net investment income tax as it relates to trust and estates, which was the 3.8% surcharge. So a choice of a trustee can affect whether or not the trust is subject to the NII. So if you have a trust fiduciary that materially participates in a trade or business activity that's held by a trust, this is a good way to actually avoid the implications of the NII. So, selection of a trustee or maybe switching of a trustee may make sense if a trustee is actively materially participating in a trade or business activity that's held in a trust. Another thing to maybe consider also too is reconfiguring investments. So maybe investing in tax exempt securities instead. This will also help, mitigate the NII consequences at the trust and estate level. So.
Yeah, and thanks, Lisa. And there's also a question out there about the website for the energy efficient credits. It's the energystar.gov website. You can just Google it and it'll come up. Otherwise, my email will pop up at the end of the slides here. You could shoot me an email and I could send it to you. And there's this, it needs a certain wattage or whatever for like the air condition. So it's all on there.
Okay, I think one more question which I get asked quite frequently is, does wash sales rules apply to cryptocurrency? So there's no official IRS guidance on it, but keep in mind that crypto is treated as property and not stock or security. So currently the wash sale rules do not apply. There was legislation under Build Back Better Act where IRS was trying to bring cryptocurrency under the wash sale rules too. But just keep in mind, IRS can always disallow the loss if they see that you're continuously doing tax loss harvesting. I think in the interest of time, we have a few more questions which we will not be able to take, but we will get back to you in form of an email or maybe reach out to you. We do have all these questions lined up. We'll just like to, get the last polling question in. What country consumes the most chocolate per capita? Giving it a few more seconds. Can you close the polling, please? Yeah, and the answer is Switzerland. We covered a lot of material today, and if you have any follow-up questions, our email addresses are up there. With that, we come to the end of this webinar, and wishing everybody a happy holidays and a happy, healthy new year from the Sax family to yours. Thank you.